Welcome back to Investing Talk podcast. Today we're taking a close look at WAG Group Co. You sent us some information covering their business, recent performance, some analysis, and our mission really is to unpack what's most important for you to understand right now.
Right, and we have sources that outline WAG's overview, their recent journey, a look under the hood at the financials, and also a general sort of due diligence report from late March last year. So it should give you a pretty well-rounded perspective.
Okay. And you mentioned wanting to get up to speed quickly, but, thoroughly. You appreciate those aha moments without feeling buried. So we'll focus on the key takeaways, maybe potential surprises in this info.
Sounds good.
So starting with the basics. WAG's core business, it seems to revolve around its platform for pet services. They really pioneered that on-demand dog walking back in, 2015?
That's it. And they've built up a really significant network of caregivers through their app, over 500,000 apparently.
But what's interesting, and you flagged this, is how they've branched out beyond just walking.
Yeah, they've moved into Petted, which is for pet insurance comparison, Dog Food Advisor for reviews.
Woof Woof TV for content. Maxbone for pet products.
Right, and even Pharmacy for pet prescription software. It looks like, a very deliberate strategy to diversify, build multiple income streams.
Okay, but here's where things get a bit, concerning. This Nasdaq delisting notice.
Ah, yes. That came through because the stock price fell below the minimum bid requirement, effective April 3rd last year.
And crucially, we haven't seen any updates saying they successfully appealed it. That feels like a pretty big deal.
It really is, and if you look at the financials leading up to that, their 2024 results, full-year revenue was down 16%.
16%. Ouch. Down to $70.5 million from $83.9 million the year before?
Correct. Now, their Q4 revenue did meet the forecast, $15.4 million. But the adjusted EBITDA for the full year, that flipped to a loss.
A loss how much?
$1.1 million loss. Compared to a $700K profit in 2023, that's quite a swing.
Wow, okay, so that 16% revenue drop really sets the stage for why their next year's forecast is so important.
It does. Because looking ahead to their 2025 guidance, they're actually projecting revenue to climb.
Climb. By how much?
Between $84 million and $88 million. That's like 19 to 25% growth year over year.
That's ambitious given the previous year. And what about profit?
They expect adjusted EBITDA to be back in the positive, around $2 million to $4 million.
And they're pinning that on wellness partnerships and AI.
That seems to be the plan, yes. Wellness partnerships and using AI integration more effectively. It suggests they're aiming for a significant turnaround.
Which brings up the question of financial health, doesn't it? You mentioned something in the Q4 report about exploring strategic alternatives. What does that usually mean?
Well, it's often code for a company feeling some financial pressure or maybe wanting to boost shareholder value somehow, sometimes both.
So what kind of alternative? Like selling parts of the business? Merging?
Could be anything from mergers, acquisitions, selling off assets, maybe even taking the company private, though that seems less likely here. It signals they're evaluating fundamental changes.
Okay. And digging into the financial metrics themselves, some red flags seem to pop up. A negative PE ratio.
Yes, negative 0.59, which typically means, the company isn't profitable on a per-share basis.
And the debt-to-equity ratio? The report said it was hugely negative, something like minus 300 and 877%.
That's right. And the reason given is negative shareholder equity. Basically, liabilities exceed assets. That's a serious indicator of financial strain, potentially solvency issues.
And cash flow
Also looks negative. Their cash and cash equivalents dropped pretty significantly, from over $18 million down to about $5.6 million. So they seem to be burning through cash.
Okay, so quite a few warning signs there.
Right.
But it's not all doom and gloom, is it? They do have strengths.
Definitely. Their brand name in on-demand pet care is strong. They were an early mover, remember?
Right, and that diverse portfolio we talked about earlier, Petted, Dog Food Advisor, etc., that could provide some stability and cross-selling chances, couldn't it?
Potentially, yes. If managed well, it offers multiple touch points with pet owners.
How do they stack up against the big players, like Petco or Chewy?
It's a tough market. Petco has that huge retail presence services, too. Chewy dominates online supplies. WAG's niche, its edge, seems to be specifically in those on-demand services and the breadth of its digital offerings.
And they were trying to build on that, it looks like. Rebranding Dog Food Advisor, launching Furscription. These are recent moves.
Yes, efforts to enhance their offerings. Those could potentially improve market sentiment if they gain traction.
So potential catalysts. successful strategic alternatives, whatever those turn out to be,
Well,
new product launches, growth in their core services.
exactly. But you have to balance that against the risks. Competition isn't going away, it's probably increasing. And regulatory changes are always a possibility in this space.
And that ever-present delisting risk still hanging over them?
Absolutely. That impacts stock liquidity, investor confidence. It's a major hurdle.
Speaking of the stock, you mentioned the price was around 11 cents back in late April last year.
Yeah. Which is exactly why they got the delisting notice. It was trading below that dollar minimum for too long. That risk undoubtedly weighed heavily on the price.
Interesting, though, that even with all this, some analysts are still finding positives. Craig Hallam pointed to wellness partnerships.
Correct. They highlighted those partnerships specifically as a potential growth driver. So even amidst the challenges, some external observers see avenues for growth.
So comparing them briefly again, Wag's in that on-demand service lane, Petco's got the physical footprint, Chewy owns the online retail space for pet stuff.
And right now, based on these financial metrics we've looked at, WAG appears to be underperforming compared to those larger peers.
Okay, so let's try to synthesize this for you. Wag Group Co., it's a really complex picture, isn't it?
It really is. You have a company that was genuinely innovative, pioneering a service. They built out this varied portfolio of pet-related businesses.
But they're facing some serious financial headwinds now. That Nasdaq delisting is a stark signal, alongside those pretty concerning financial indicators like negative equity and cash burn.
The potential for a comeback, for that turnaround they're forecasting, seems to really depend on executing those strategic alternatives successfully.
Whatever they may be.
Right. And seeing real growth from the wellness partnerships and the AI integration they're talking about.
But you absolutely have to weigh that against the financial strain they're clearly under and the intense competition in the pet care market. Those are major factors for you to consider.
It really boils down to a critical question, doesn't it? Can WAG leverage that early lead it had and its diverse range of offerings strongly enough to overcome these current financial hurdles and actually capitalize on what is generally a pretty resilient pet care market?
That's the core question. So we definitely encourage you to do your own further digging. Keep an eye out for any news on that delisting appeal if it ever materializes.
And any specifics on those strategic initiatives, plus, of course, their upcoming financial reports. SEC filings and financial news platforms are your best bet for real-time info.
And if you found this focus exploration valuable, please do subscribe, like, and maybe leave us a comment. We're always interested in the sources you send our way to unpack next time.